Learn Accounting Podcast by Professor Accounting, Episode 13, Company Accounts, Bonus and Rights Issue of Shares. I had a request over on YouTube to do this topic, so I'm going to just jump straight into it in terms of that topic for issue of shares, in terms of bonus and rights issue. I just mentioned I would go, obviously before teaching this, I would go through a lot of company account topics such as selling of shares, basic selling of shares, going through the appropriations account, getting used to some of the key terminology. You're going to see some terminology here that hopefully you do know if it's a revision. If not, I'll try and give you some extra terms or some explanation about them just briefly, because I want to make sure I actually teach this topic here to the original poster and anyone else that's interested in this element for a revision of the topic. So in terms of the overview, a company can do more than just sell shares. So this is where I would pick up on from the last the way I teach it. So we can just sell shares as it is, typically on the stock exchange for PLCs or to friends and family if we're a private limited company. But we need to look at the two types of issues, bonus issue and rights issue, and we've got to find some specifics about these or features about these to break them down to know the differences. So I'll do that in here. There's one example of each, and also a table with some key distinctive features about these. So let's start. Bonus issue. Nice definition in terms of phrasing of it. It's a bonus, so we're thinking of free maybe, but it used to be called, or old term is scrip issue. So let's just look at my definition for a bonus issue. The issue of additional shares to shareholders in proportion to their existing shareholding. So break that down. What's the key information? Well, yes, we're issuing shares. It's to existing shareholders only, so it's not to new shareholders. And when we issue them to existing shareholders, they're in what's called proportion. So that's like a ratio. So brief example, just to say, if existing shareholders, if we want to give one bonus share for every 5 shares each shareholder holds, then if one shareholder holds 5 shares, they're going to get one extra share, one bonus share. If a shareholder has 10 shares in existence already that they're bought, they can get 2 extra shares, 2 bonus shares. And if a shareholder has 15 shares, they're going to get 3, because it's a ratio proportion of 1 to 5, for example. So it works the same for every shareholder. So as I've said, bonus, nice word to use, it means free. So these are free shares to shareholders. So shareholders are not buying these types of shares when they are offered, when they're issued. These are free shares, so the company is paying for this. So it's important we understand that the company is funding this, because typically in exam questions you have to show evidence of that with what's called a restructuring of the capital and reserve section of the balance sheet. So again, I'll come on to that at some point, maybe in the last slide with the terms. So free shares. So just another point, why what's the reason we give bonus issues? A whole load of reasons, but just a starter, why are we giving free shares to shareholders? I thought the idea was to sell shares to shareholders to get them to invest and raise money. Well, we have to give a little to get a little. So in terms of reward for investment, we have to maintain and keep shareholders happy. So shareholders, what are they looking for? Well, they're looking for money typically, obviously stability and so on. But short-term gains and long-term gains is the best way of looking at it. Short-term, maybe over a year period. Long-term, anything in accounting, I suppose, beyond 5 years. I know long-term really is 20 to 30 years, but they're linked to the future as well. So short-term gains. What do shareholders get for short-term gains? Well, they typically will get a dividend. And that's every year or every 6 months, which obviously means two times in 1 year. So they get a dividend, and the dividend is a share of the profits. And that will obviously keep them happy for the short term. But what if a company doesn't make a profit? If they don't make a profit, if they're making a loss, then shareholders will not get a dividend, because there's no profit to give any dividend from. So that is why dividends are not compulsory. If they're not compulsory, they're not legally binding. So obviously, if a shareholder isn't receiving dividends, they may decide to divest, leave, and go elsewhere. So short term, they're looking for dividends. Long term, what are shareholders looking for? Well, they're looking for the ability in the future to take their investment and sell it at a profit, and we call that capital gain. So capital gain is where you've been investing for a while, and they take the investment and sell it to someone else for a higher amount. So you might have heard of capital gains tax, which is what they will pay on that gain there. So long-term incentive. Well, how is a bonus issue an incentive? Well, a bonus issue is an incentive because we're giving them free shares. Free shares which will affect the dividend that they're going to get each year, if obviously dividend can be paid, but also it's more shares for them to sell in the future, if and when they decide to do that. So briefly, I say briefly, again there's lots to say about it, but that is just hopefully a snapshot about bonus issues as an overview. Let's get into some numbers and get thinking about this the bonus shares. So I'm going to got 3 examples here, calculations. I'm going to do Science Limited, and you do the last 2. When I've done this first example, you can just pause the podcast and you can answer the next 2, and then just work them out, and then come back, press play again, and then you'll see the answers that I'm going to go through. So, question: calculate the number of bonus shares in each example. I'm going to do, I've just told you there, do the example, and don't forget to show your working. So please do show your working when you're doing this. Right, so let's just look at the information. I'm going to move over to Excel to help in terms of some of the number crunching. Issued capital, in this case, is issued ordinary share capital. I'm not looking at preference shares at the moment. Issued ordinary share capital. So issued ordinary share capital is £3 million. And the face value, key terms, right, face value. Some examples like to change the terms and look at rephrasing it, but you can have face value, you can have nominal value, and you can have par value, like in golf. So they all mean the same thing. Face value tends to be the more common one that students do generally understand. That's why I've used it in the grid. But it's the ticket price, it's the share price in terms of every share price has a standard price, an expected price. But obviously not every share is sold for £1, because depending on trading conditions, if a company like Science Limited is doing very well, then they may be selling it for a lot more than £1, maybe £3, £4, £5 if they're trading very well, if they're profitable, if they're maybe growing, or they've got a clear plan, or maybe they're beating competitors and so on. However, it could be quite bleak for them. It could be maybe poor trading performance over a seasonal period. Maybe obviously with the summer period they didn't do very well, or the winter period for the Christmas period, the trading performance is low, so the share price will fall. You have to keep a value, so the market value is changing, but the face value, the nominal value, the par value is not changing. So that's the ticket value, we call it. So I'm going to call it the par value, and in this case it's £1. So what have we worked out there? Well, we're trying to work out the quantity of shares. Now I know it's not difficult in the first one. It's £3 million divided by £1, and you get quantity of shares. So that means there's 3 million shares sold at £1 to get £3 million. So I know it's basic maths, but it's getting around what the information means. So let's look at the scale. It's got 1 for 2, bonus to existing. So 1 bonus share for 2 existing shares. So what you need to do now is, with the harder bit for just the procedure, we've got 3 million shares issued. Don't forget there's another term called authorised share capital, and that is the current maximum amount of shares or share value that can be in existence. So that could be, say, 4 million in this case, for example, and they've only issued 3 million, so they could issue another £1 million shares at £1 each. As an example, I'm not on the question there, but just do look at authorised share capital as a key term. So back to the question, we need to look at how many sets we've got in existence. So quantity of shares, you're at 3 million. We've got 2 sets. So we're looking for, where did I get that from? Well, you need to look at the bonus to existing. So 1 for 2. So for every 2 shares in existence, well, there's 3 million shares in existence, so I want to know how many sets of 2, or pairs of 2, or I suppose it has to be pairs if it's 2, or lots. Sometimes it's worded as lots. How many lots of 2? So if you've got 3 million pieces of paper and you put them into piles of 2, then how many would you have? Well, you have 1.5 million sets of 2. So that's what we're doing. The next step is to then say, well, if we've got 1.5 million sets, we're going to give 1 extra share, so 1 bonus share, and that is 1 times the number of lots. So yes, it's the same answer because it's times by 1. So your answer for Science Limited is, with this bonus issue, there is an extra 1.5 million shares in total. being given to the shareholders. And I say that in total. It's not per shareholder. That's in total. Okay, that's the question. That's the task. I want you to work that out for Maths and Accounting Limited. Might look straightforward. Might look easy. Might be complicated. You may never have seen it before. Pause the podcast now and you try and work out, a bit more complicated with some of the numbers. You try and work it out. Obviously, it's very easy for me using Excel, but you need to use pen and paper or calculators as well, and do show some working out. So pause it now, work out the two values. I want to know how many bonus shares for the last two examples. When you get your answers, and you have answers, make sure you do it, then play the remaining of the podcast and I'll show you the answers. Okay, so you've obviously pressed play again, and now you're looking for me to go through the solutions. So I do this on the Excel to try and make it as quick as I can, rather than having to watch me handwrite. So if we do Maths Limited, we just use the numbers. Let's say it's 2,800,000, and the face value is 50 pence, so it's 0.5. Well, that makes sense. The quantity of shares is obviously double the value of issued share capital, because it's only 50 pence a share. So you get 5.6 million shares. The ratio, the proportion of the scale bonus issue is 2 to 1. So that means you want to know how many sets of 1. Well, it's the same value, and you're going to give 2 bonus shares, so it's twice as many as the sets. So your answer you should have got was 11.2 million. 11.2 million for Maths Limited. Hopefully you got that right. Accounting Limited, you've got 1.5 million. The par value, the face value, the nominal value is £5, quite high, that one, and therefore the quantity of shares is 300,000. So it's 3 for 4, 3 bonus shares for 4 existing. So rather than just look at it as numbers and getting numbers back, really think about this. Why are we dealing with the 4 first, not the 3? It's important you look at the existing first, which is the number 4. So how many sets of 4 do we get from 300,000 shares? Put them into piles of 4, we get 75,000 piles of 4. Sets of 4. So we're going to give 3 shares for every set. That gives you 225,000 shares. So the number of extra shares, the bonus shares, the free shares, is £225,000. That's your answer for the Account Limited. Hopefully you've been useful. Hopefully you found that useful for bonus issue. Let's now go over and look at the next bit of the PowerPoint. So we're going to look now at the rights issue. A bit different, so I'm going to start off with just a little scenario. I'm going to leave a gap there. I'm going to do a definition in a moment. Company A issued a share capital again, so I've got 900,000 ordinary shares of £1 each. So now you know those 3 terms that I mentioned. The same term means the same thing: par, face, nominal. What is the par, face, nominal value in this case? It's £1. The proposal is to make a rights issue and offer existing shareholders 2 shares for every 3 currently held. This does look a lot like a bonus issue information, but it's not. It's a rights issue. So that's the similarity. However, this is new. Share offer price £2.70 per share. So this is where it's different. Rights issues, we're selling shares to existing shareholders and offering them a price of £2.70. So I'll explain in a moment what this offer means. Assuming the rights issue is fully subscribed, again, fully subscribed is a term that you need to be familiar with by shareholders. Calculate. So I'll just put these on the slide so you can see what we're going to do. I want the cash received from the rights issue. So yes, we do get money from shareholders from this rights issue. And I want the increase in the share premium from the rights issue. So a new term, share premium. And I will go through what that is. So definition. A rights issue, an issue of shares for cash, where the existing shareholders are offered the right to buy the shares at a price below market price. Okay, so straight away there, we're basically, in short, let's look at this. We're trying to raise money with a rights issue, and we're selling shares at a discounted price. So that's the offer. That's what it means by offer. I know we're just saying, do you want to buy shares? That's offering, but the offer is the £2.70 per share. That will be a reduction, a reduced price to the market price. Because what's the incentive in buying the share? If there's no incentive, as in a reduced selling price, then why would you buy the share? So £2.70, the normal price could be, say, I don't know, £3, £4, £5, something. I wouldn't necessarily say it's always the case, but it's certainly got to be cheaper than the market price currently. So that's the first element to it. I've not put it on there, but I'll just mention it because it's so important. Why do we call it a rights issue? This is why. Existing shareholders have the right to buy these new shares at a discounted price, but more so is that they have the right to sell their existing shares. Why is that? Well, this is an offer. So I know it's this share price is cheaper than as an incentive to buy more, but you have to spend money. So obviously, so what if you didn't want to buy the shares? What if you weren't prepared to pay this price? And it may just be you, it may be some other people as well. Well, if you don't want to pay, buy these new shares at this discounted price, you have the right to sell your shares. And it's actually going to be in your best interest to sell them if you're not going to buy, because, well, think about it. Why? If other shareholders do buy into this deal, then they're going to increase their quantity of shares. And if you don't buy anymore, then they're increasing their shareholding and you are not. So as a proportion, as a percentage, that you are going to be lower in terms of your equity. You're going to be owning a lower stake after the rights issue has taken place, and therefore disadvantaged in terms of dividends and control of the company. So that is also a situation. You've got the right to sell the not these shares, your existing shares you own. So it's kind of leaving in a sense. So that is again an overview. Anything else to mention just briefly? Nothing else, I think, but this is a proposal, so it's offering to shareholders. Now let's look at the calculations and look at the question. So A, I want the cash received from the rights issue. So how much money does this rights issue is it expected to generate? Well, let's look at the information. We want to know how many extra shares are going to be offered for sale. So we've got 900,000 shares in issued already, and the offer is 2 extra shares for every 3 shares. So we need to divide 900,000 shares by 3, and that will give you the lots or the sets. So here it is on one line. So it's 2 for 3. 900,000 divided by the 3, and that gives you 300,000. Times it by the 2 extra shares, so that's 600,000 extra shares. Hopefully you're still with me at this point. So that's 600,000 extra shares that has been potentially going to be sold. And I say that, but even though the question is assuming that the rights issue is fully subscribed, so that means that 600,000 shares, the shareholders have come back and said we want them all. So they are going to buy the whole shares, all the shares. So 600,000 shares would therefore be sold. Well, how much would they be sold for? £2.70 each. So £2.70 times 600,000, you're going to get 1.62 million. £1,620,000. That's your answer. B, the increase in the share premium from the rights issue. So what do I mean by this? Well, let's look at what share premium is. Share premium. In this case, share premium is the difference between the issue price, so that's the £2.70, and the nominal value, the par value, the face value. So this is a £1 share that you're selling for £2.70. So the difference between that is the share premium per share. So £2.70 minus £1 is £1.70, but that is per share. So I know question B doesn't actually say the total share premium, but that is what it's meaning, because it wants the increased share premium, so the total share premium. So think of it in that way. And I think of share premium straight away in the balance sheet, because that's where it belongs. So total share premium is what we just said. We need to work out the £2.70 minus the £1 to get £1.70, but don't forget to times it by the 600,000 shares, because you're getting £1.70 share premium for every share that is to be bought by the shareholders. And since it's fully subscribed, it means that the full 600,000 extra shares will be bought. So multiply together and you get £1,020,000. Hopefully you found that okay. Hope you found it interesting, useful as a little revision tool. Let's just quickly now go over to a summary as to the differences between the types of share issue. So again, you may as well copy this down as well. It's useful notes. I think it's in the textbook that you would use, but see how you find it. I want to compare bonus issues and rights issues. So a bonus issue, additional shares given free to existing shareholders. Compare that to the rights issue. This is additional shares that are offered for sale to existing shareholders in proportion to their holdings. So I know this in proportion is there. It's actually the same on the bonus issue, which I've got on the left a bit further down. But the key difference there is bonus issues are free, rights issues are for sale. Next one. I said it previously actually. When a bonus issue is given, a shareholder will not turn away free. So when bonus issues are made, this is it's free shares, so the company will pay for it. So what we call this when the company pays for it is, I've got there the capitalization of reserves into share capital. So this is recapitalizing share of reserves, and in this case this is basically a restructuring. This is where the capital section and the reserve section in the balance sheet, hopefully you can visualize it at the moment, where you've got the ordinary share capital, the preference shares, share premium, you've got retained earnings and so on. That just basically changes structure, changes order. I must show you an example of it to really fully appreciate what that means. Whereas the rights issue, these are the offer price is below the current market price. So that's the real incentive. It has to be lower than the current market price. By how much is it's dependent on the directors of the company in terms of how they offer to shareholders. Distributed in proportion to existing shareholding. So again, that's the same really as rights issues. Just fit it into the first one of the bonus issue. Shareholders can either buy the additional shares and can sell the rights on the stock market. So that's what I mentioned before. They have the right to buy extra shares or sell their shares if they don't want to buy into the new rights issue. Otherwise they'd lose out. They could lose out if they don't buy. Bonus issues, no payment is made for the shares. Very important. No cash is received because the shares aren't being sold to the shareholders. They're given for free. Company receives payment from the shares sold. That's true because we're selling them. In OCR, you do you actually do a topic on shares issued, and you do the ledgers for selling shares. So you should know that a lot more. And typically, when you buy a share, you don't pay the full price first anyway. You pay in instalments. Lastly, stock market price of shares, they fall in proportion to the bonus issue. So again, this will be useful for economics students, business studies students, as to understanding maybe the economy and so on. So economics students have to appreciate it to an extent, or maybe look at this as a little example. But what we're saying there is, if the stock market price why is it falling? Why would the market price fall? Well, if you're giving free shares, then you're giving free shares to existing shareholders, then they're not buying anymore. So you're devaluing your company in a way. You're devaluing the share price until a later stage. It's only a short-term fluctuation. Lastly, as well, on rights issue is the stock market price of shares may fall slightly because the offer price is below the current market price. So, I mean, it is linked in some way to the bonus issue. It falls slightly because there's only a small reduction in the offer price. So until these shares are consumed, they're fully subscribed, again, until that's happened and they have the right to buy or sell those shares, then it's finished. That's occurred. They can then now start to look at buying normal shares from the stock exchange at a later date after this transaction of the rights issue is completed. So hopefully there you've seen quite a bit in the podcast. I try and condense this, but there's so much to talk about. Hopefully you find it useful, the original poster, and other people that have tuned in to watch this topic. My details, just to remind you, drop me an email, drop me a post on YouTube. You can contact me through YouTube. And again, I'm on your student rooms from time to time looking at posts from students wanting help. But again, you can always catch me via my email. Drop me an email. And hopefully, again, like I said, if you find this topic useful, I'll try and get to do some other topics that link to this as well as an overview. But any questions you've got, please do drop me message. So I want to thank you for stopping by. This has been a podcast from Professor of Accounting, and I'll see you next time.